Welcome to Multnomah Group's second quarter 2025 market commentary. I'm Karen Sanchez, a senior investment analyst with the firm. Our first section is on the economy. GDP contracted in the first quarter of 2025 following several quarters of gains. GDP declined at an annualized rate of 0.5%. The largest detractor was an increase in imports as retailers sought to build inventories in advance of higher tariff rates. Government spending also declined. These effects were partially offset by increases in investment and consumer spending. Second quarter GDP data will be released July 30th. Employment remained healthy in June with the unemployment rate at 4.1%. Non-farm payrolls rose by 147,000, and wages grew at an annualized rate of 3.7%. However, the Fed has noted they are watching for any impacts from immigration policy changes and the potential for higher tariffs to reduce corporate hiring. In June, CPI increased at an annualized rate of 2.7%. This reflected increases in prices for household furnishings, medical care, recreation, clothing, and personal care. Core CPI, which includes all items less food and energy, rose 0.2% in June as the annualized rate hit 2.9%. The Fed's preferred measure of inflation is PCE, the Personal Consumption Expenditures Index, with a target of 2% inflation. In May, core PCE grew at an annualized rate of 2.7%, and consumer spending decreased $29.3 billion from April. According to the University of Michigan surveys of consumers, June saw a 16.3% increase in consumer sentiment over May. However, consumer sentiment is down overall 11% from 12 months ago. The University of Michigan surveys show consumers continue to be concerned about inflation and the potential impacts of higher tariffs on imports. There is an expectation that prices will rise 5% over the next year and 4% over the next 5 years. Next, we turn to the fixed income markets. Following 100 basis points of rate cuts in the latter half of 2024, the Federal Reserve has continued to hold rates steady through the second quarter. The current Fed target is a range of 4.25 to 4.5%. The yield on 2-year Treasuries was 3.72% on June 30th. Yields on the 5 and 10-year maturities were 3.79 and 4.24 respectively. The yield on 30-year Treasuries was higher at 4.78%. The yield on 3-month Treasury bills was 4.41% as of June 30th, a 9 basis point increase from 3 months ago. For the quarter, the Bloomberg U.S. Aggregate Bond Index was up 1.2%. Returns by sector were positive, except for long government credit, down 0.2%. Developed international bonds led returns up 7.6%, followed by high yield up 3.5% and emerging markets debt up 3.1%. Turning to U.S. and international equities markets, the broad market S&P 500 index was up 10.9% in the second quarter, but there was a wide variance in market sector returns. Information technology led up 23.7%, and communication services and industrials were also up strongly with returns of 18.5% and 12.9% respectively. However, energy was down 8.6%, and healthcare also significantly lagged, down 7.2%. For the 1-year period, the S&P 500 was up 15.2%, led by financials up 29.4%, and utilities up 23.4%. Healthcare and energy posted negative returns for the period, with healthcare down 5.9% and energy down 4%. Growth stocks outperformed value stocks for the quarter. Mid-cap growth led returns up 18.2%, followed by large cap growth up 17.8% and small cap growth up 12%. The trend was similar for the 12-month period, with mid-cap growth outperforming all other size and style factors. For the quarter, both developed international and emerging market stocks outperformed the U.S. broad market, as represented here by the Russell 3000 index. Developed international markets were up 12.3%, outperforming the U.S. market by 1.3, and emerging markets were up 12.2%, outperforming the U.S. market by 1.2%. On a regional basis, Latin American emerging markets outperformed all other regions with a return of 15.4%. The lowest return for the period was in the European, Middle Eastern, and African countries, represented by the emerging markets EMEA index, up 7.7% for the quarter. Developed international markets and emerging markets also led the U.S. market for the one-year period. Developed markets outperformed the Russell 3000 index by 4%, and emerging markets bested the U.S. index by 0.7%. Finally, we turn to our market outlook. There is tension between the Federal Reserve and the White House regarding the timing and depth of future rate cuts. While the White House has stated a strong preference for faster, deeper cuts, the Fed is taking a more cautious approach as they monitor the effect of higher tariff rates on the economy, inflation, and employment. Treasury futures trading implies little expectation for a rate cut at the Fed's July meeting, but still holds on to the possibility of 2 to 3 rate cuts later this year. Most tariffs have been paused until August 1st as the White House continues negotiations with key trading partners, including China, the Eurozone, and Japan. The White House has issued tariff letters to several nations detailing their expected rates absent further negotiations. As the second quarter earnings season approaches, Wall Street is looking for early impacts of tariffs on corporate finances. The federal deficit was the elephant in the room during the second quarter as Congress negotiated over Trump's tax and spending bill. The big beautiful bill was passed in early July, and initial assessments conclude the bill could add up to $3.3 trillion to the deficit over the next 10 years. With the pause on tariffs expected to end August 1st, little progress on trade deals with affected countries, the aforementioned tension between the White House expectations and Federal Reserve action on interest rates, and continuing conversations regarding the federal deficit, economic uncertainty is high, and we should expect short-term market volatility in the months ahead. This closes our quarterly market commentary for the second quarter of 2025.